In order to control the kinds of wild price swings that you might see in a market that was dominated by speculators, commodity futures exchanges typically tried to maintain position limits on speculators, clearly delineating or distinguishing between commercial hedgers and those who are simply there to speculate on price changes. Speculators had always been allowed to participate in markets on the hope that their superior analysis might convey some new information that had been otherwise overlooked by various kinds of market participants, creating a little bit of space for the Nathan Rothschilds of the world to profit by providing information about the true state of affairs. Now, this, of course, all changed in 2000 with the introduction of what was called the Commodity Futures Trading Modernization Act in the United States. The most important aspect of this regulatory change was that it clarified that derivatives were neither securities nor commodities, and thus was not the markets for them were not subject to the regulatory oversight of either the SEC, the Securities Exchange Commission, or the CFTC, which is the regulator for derivatives, for commodities. Now, of course, what naturally happened is that in this seemingly freshly deregulated space, we saw a substantial amount of financial innovation taking place. In particular, the creation of what were called commodity swaps, which allowed for investors to effectively buy financial exposure to price changes on commodities. Now, as they proceeded to buy exposure to commodities, of course, their market maker needed to hedge the risks that these swap contracts created for them. And this meant ultimately that the market makers, investment banks like Goldman Sachs, found themselves with substantial financial exposures, which exchanges like the ICE were willing to recategorize as simply being a hedger. This effectively opened the back door to commodities exchanges wide open for financial speculators to dominate the market. And as you can see at the graph at the top of this slide here, between the beginning of 2002 and the middle of 2008, a broad index of commodities literally triples and then some before being dramatically cut down in half, leading it up to the beginning of 2009. A lot of this rapid decline happened because the commodities exchanges wanted to try to drive speculators out of the market ultimately. There were substantial complaints that were being made regarding how commodity prices were suddenly wildly out of whack with actual supply and demand in the real market, with many people noting that it was in fact financial demand for exposure to commodities that was driving up prices of wheat and soybeans and oil to historically high prices. Well, as these prices began to reach all-time highs and effects began to be felt in the real economy of suddenly having, say, $140 barrel of oil, what we saw is that the exchanges tried to put a stop to the speculators by raising margin requirements substantially. This drained all of the wind out of the speculators' sail and led them to substantially reduce their positions. As a result, with so many people selling into the market, we see commodities prices on average crashed substantially down to less than half of what they had been just 6 months earlier that summer. But this isn't the only role that OTC swaps played in the 2008 financial crisis. In particular, one type of OTC swap, the credit default swap, played a somewhat oversized role. A credit default swap is effectively insurance against the possibility that a bond issuer is going to default. So party A borrows some money and parties B and C get into a side bet as to whether or not party A is going to default on their debt. If party A does default, party B will pay out to party C a rather substantial amount of money that would help to hedge party C's exposure to the original default. What does party C pay for this kind of protection? A regular premium to whoever the issuer of the credit default swap happens to be. Now, the largest seller of credit default swaps leading up to the 2008 crash was American insurance giant AIG, which consistently underpriced these kinds of securities, or these kinds of derivatives rather, in order to capture market share. There was one division responsible for this out of tens of thousands of people around the world who worked for AIG. And in this case, a division led by John Cassano that you can see at the top of the slide here, and just 337 people ultimately wrote enough credit default swaps to destroy one of the largest insurance companies in the world. By the end of summer 2008, AIG had written over $440 billion worth of bond guarantees. They were not a market maker who was buying and selling credit default swaps. They intentionally had taken a directional position on this, simply assuming that their models would protect them and the prices were only going to rise. In the somewhat infamous words of their boss, John Cassano, in 2007, it was described as hard for us, and without being flippant, to even see a scenario within any realm of reason that would see us losing $1 on any of these transactions. Well, interestingly enough, just a year and a half later, AIG had lost over $100 billion on those transactions, ultimately pushing the company to the brink of bankruptcy. Rather than allowing the failure of such a large insurance company to domino through financial markets and potentially set off an even worse crisis, the US government stepped in and pumped $182 billion into the insurance giant in order to stabilize it. 4 years later, it was finally able to sell out its 80% stake at a $22.7 billion profit, pointing out that while AIG had taken substantial losses on those credit default swaps, that its underlying business was in fact relatively stable. Unfortunately for them, they simply got involved in a particular kind of security that they didn't understand particularly well and nearly destroyed their own firm, certainly almost the global economy with it. Now, governments have learned from these kinds of crashes. Just like governments attempted reforms in stock markets after 1929, we see that governments attempted to reform the market for over-the-counter traded swaps, the kinds of things that had caused so much trouble both in commodities markets and in the credit default swap market. Ultimately, the idea was to try to centralize the trading of swaps, to try to prevent these kinds of derivative chains that we had seen in the Dutch tulip bubble from reoccurring. And that meant removing people's bilateral swap exposures and moving them to a centralized swap execution facility that would effectively formalize the role of what a swap dealer were individually conducting for their own private accounts. Now, there are still a large amount of swaps that are being traded bilaterally, but the overall trend in the industry towards swap execution facilities is clear. As a further update, in just November of 2020, the Federal Trade Commission imposed limits on speculation in critical commodities, including the kinds of synthetic derivative positions that Goldman had been able to create with their OTC commodity swaps. From this point forward, even synthetic derivatives that are based off of these 25 underlying core commodities will be subject to position limits. One final thing that's maybe of interest to people is the explosive attention that retail investors have given to the options market in the last 18 months. In general, binary options have taken this market by storm, with advertisements appearing for them in your spam folder as we speak. The first binary options really occurred as an OTC product starting back in the 1970s, but they weren't available to the general public. This was the sort of instrument that was only packaged up for sophisticated institutional traders who had some quantitative risk they were attempting to control. Nonetheless, binary options rolled out to the public in 2008, and over the last decade have become rapidly gamified. You can now download apps on your phone to start trading binary options in just a few minutes, allowing you to open as many as 6 separate positions with a 1-minute expiration period at the same time, allowing people to effectively gamify what used to be a market for hedging risk exposures. On top of that, retailers, not to be outdone by binary options, have poured into regular option markets with the advent of the COVID-19 crisis. People stay home and seem to be turning to markets more for entertainment purposes than necessarily the allocation of long-term capital. In particular, we've seen a lot of demand in markets for call options on popular tech stocks like Tesla and Apple over the last 9 months leading up to the spring of 2021. And the result of this massive increase in demand for call options has been, of course, that the market makers who sell these call options need to hedge by owning the actual underlying security itself. And as a result of massive increase in demand for call options among retailers, there's been an increase in purchases by market makers who are offsetting their risk, which of course drives the price of these stocks even higher. Throughout the back half of 2020, small trades with less than 10 contracts at a time constituted more than half of the total call market premiums on certain kinds of stocks, suggesting that retailers have moved in en masse into markets that were traditionally dominated by sophisticated investors, hedgers, and with a small speculative presence. Interestingly enough, you can see the volume of call options being traded has spiked up dramatically in the last couple of years. And unfortunately, just like in many bubbles where the public all decides it's time to start trading the same kind of financial asset, it usually ends in tears. Nonetheless, for now, the music still continues and the retail option traders continue to ride. Watch this space for more details.